In 1971, a single decision changed the global financial system forever. Most people didn't notice it at the time. There were no riots in the streets, no dramatic headlines warning ordinary families. Yet that decision transformed how money worked across the world. Today, another transformation is quietly approaching, one that could be even bigger. Imagine a future where every dollar you earn, spend, save, invest, or transfer exists inside a digital network controlled by financial institutions and governments. A future where money moves instantly across borders, where cash gradually disappears, and where the rules of global trade can change overnight with a software update. Supporters call it innovation. Critics call it the greatest expansion of financial control in modern history. But regardless of which side is right, one fact is impossible to ignore. The digital dollar is no longer a theory. The race has already begun. What if the biggest change to money in the last 100 years wasn't happening in secret laboratories or Silicon Valley startups, but inside the world's most powerful central banks? Right now, governments across the globe are racing toward a new form of currency called Central Bank Digital Currency, or CBDC. Most people hear those four letters and immediately think of convenience. Faster payments, instant transfers, no more waiting days for transactions to clear. But beneath those promises lies a question far more important than speed. Who controls money when every dollar becomes digital? For generations, cash represented something unique. It was private. It was direct. It belonged to whoever held it. But a digital dollar would operate differently. Every transaction could be recorded. Every movement could be tracked. Every payment could potentially be monitored. Supporters say this would reduce fraud, money laundering, and tax evasion. Critics argue it could create the most powerful financial surveillance system ever built. Yet while the public debates privacy, a much larger game is unfolding behind the scenes. The United States isn't developing a digital dollar simply because technology exists. It is responding to a growing challenge from nations seeking to reduce their dependence on the American financial system. Countries are building alternative payment networks, experimenting with their own digital currencies, and exploring ways to trade without using traditional dollars. If the dollar has been the king of global commerce for decades, the digital age may become the battlefield where that dominance is tested. And if that battle is already underway, the consequences won't stop at banks or governments. They could reshape global trade itself. Every day, trillions of dollars move across borders. Oil from the Middle East, electronics from Asia, machinery from Europe, agricultural products from South America. Behind every container ship crossing an ocean sits an invisible financial network connecting buyers and sellers. For decades, the US dollar has served as the backbone of that system. A company in Brazil can trade with a supplier in South Korea using dollars, even though neither company is American. That dominance gives the United States extraordinary influence over global commerce. But digital currencies could change the rules. Imagine a world where transactions settle instantly between countries without passing through traditional banking systems. No delays, no intermediaries, no dependence on existing dollar infrastructure. This is exactly what several nations are exploring. If successful, these systems could reduce costs and increase efficiency. Yet they could also weaken the dollar's role as the world's reserve currency. Exporters and importers would face a new reality. Businesses that once relied on dollar-denominated transactions might need to navigate multiple digital currencies simultaneously. Exchange rate risks could increase. Regulatory complexity could explode. Some countries may gain greater independence. Others could lose access to financial advantages they once enjoyed. Meanwhile, multinational corporations are already preparing for a future where digital settlement becomes the norm rather than the exception. The question is no longer whether technology can transform trade. The question is who will control the infrastructure of that transformation. Because whoever controls the rails of global commerce often controls the future of economic power. The 20th century witnessed military rivalries. The 21st century may witness currency rivalries. Around the world, governments are investing billions into digital financial infrastructure. On the surface, these projects focus on innovation. Beneath the surface, they represent something much larger, a competition for influence. The nation whose currency dominates international trade gains leverage over markets, investments, sanctions, and economic policy. For decades, the US dollar occupied that position almost uncontested. But digital currencies create new opportunities for challengers. A faster payment network can attract businesses. Lower transaction costs can attract trading partners. More efficient cross-border settlements can attract governments seeking alternatives. This is why digital currency development has become a strategic priority in many parts of the world. The implications extend far beyond financial institutions. Investors, exporters, importers, and consumers all become participants in this transformation. A shift in reserve currency dynamics could influence borrowing costs, inflation trends, commodity pricing, and global capital flows. Financial markets may experience periods of uncertainty as competing systems emerge. Some analysts compare this moment to the early days of the internet, when few understood how profoundly digital networks would reshape society. Today, the same uncertainty surrounds money itself. We are witnessing the construction of a new financial architecture. The only question is whether that architecture will expand freedom, increase efficiency, or concentrate power in ways previous generations could never imagine. Imagine waking up one morning in a world where physical cash has become increasingly irrelevant. Your salary arrives digitally. Your purchases happen digitally. Your taxes, loans, subscriptions, investments, and savings all exist inside interconnected digital systems. For some, this sounds like progress. For others, it sounds like dependence. A digital dollar could bring undeniable benefits: faster economic activity, reduced transaction costs, improved financial inclusion, more efficient international trade. Governments could distribute emergency funds instantly during crises. Businesses could settle payments across continents in seconds rather than days. Yet every advantage introduces new questions. What happens when access to money depends entirely on digital infrastructure? What happens during cyber attacks, system failures, or political disputes? What happens when financial privacy becomes increasingly limited? These are not futuristic concerns. They are practical questions being discussed by economists, policymakers, and financial institutions today. The future of money may not be determined by technology alone. It may be determined by the balance between efficiency and freedom, between innovation and control, between convenience and autonomy. The digital dollar could strengthen America's position in global finance. It could reshape exports, imports, and international commerce for decades. Or it could accelerate a financial transformation whose consequences remain impossible to fully predict. One thing is certain: the world is approaching a monetary turning point. And when history looks back on this era, it may not remember it as the age when money became digital. It may remember it as the moment humanity redefined what money actually means. But here's the uncomfortable truth. The digital dollar may not be the final destination. It may only be the first step. Because once money becomes programmable, governments gain new tools. Once transactions become fully digital, debt can move faster than ever before. And once economies depend on digital financial systems, borrowing can expand in ways previous generations could never imagine. The question is no longer whether the world will create more debt. The question is whether the world has become trapped inside a system that requires debt to survive. And when that system finally reaches its limits, who will pay the price? Nations, banks, or ordinary people? Next episode: The Great Debt Trap: Why Nations Can Never Stop Borrowing. Every government promises fiscal responsibility. Every government keeps borrowing more. Is this incompetence? Or is the entire system designed that way? See you in episode 9.